So, let's talk about gold. Is it really just a shiny metal that we use for jewelry and stick in vaults? Or is it something way more fundamental to how our financial world actually works? In this explainer, we're digging into a pretty powerful argument that most of us have been thinking about gold all wrong. So yeah, let's get right into it.
And you know, it's a totally fair question, right? We live in a world of digital currencies, AI stocks, and all these complex financial instruments. So what's the real point of a physical, yellow rock? Is it just some ancient relic? Or does it have a critical role to play that maybe we're missing?
And this quote right here, it really gets to the heart of the whole argument. The idea is that as soon as you start thinking of gold as a metal, you miss its entire purpose. It's not about its use in your iPhone or in jewelry. It's about its incredible 5,000-year history as the most enduring form of money the world has ever known.
All right, so let's unpack that. What actually separates gold from the money we use every single day?
Well, first, we've got to understand the money that's in our wallets and bank accounts. It's called fiat currency. All that means is that it's not backed by a physical thing. Its value comes entirely from the trust we have in the government that issues it. In a way, every dollar is just a form of IOU from the central bank.
And here's where the difference becomes crystal clear. Fiat money can be created out of thin air, which means it can and does lose value over time. It always carries risk. But gold, it's finite. You can't just print more of it. It's a real asset that doesn't rely on anybody's promise to have value.
This key difference leads us straight to a fundamental problem that's kind of baked into our modern financial system, the debt cycle.
And this creates a cycle that's actually pretty predictable. When debts get too big to be paid back, the easiest solution is often for central banks to just print more money. Now that might seem like a short-term fix, but all it really does is make the money you've saved worth less. In that kind of scenario, gold acts like an insurance policy against your savings getting wiped out by inflation.
Okay, so if gold is this kind of financial insurance, how does it stack up against some of the other options out there? Let's take a look.
You might think of other precious metals like silver or platinum, but here's the thing. Their prices are much more tied to industrial demand, which makes them way more volatile. Gold's value, according to this perspective, is uniquely anchored to its thousands of years of history as money.
Now what about something like an inflation-indexed bond? Well, a bond is still just a promise from a government to pay you back. Gold isn't a promise, it is the payment. Its value doesn't depend on anyone else keeping their word. That's what the experts call no counterparty risk.
And of course, you've got high-growth stocks. They can offer absolutely huge potential, but they can also be incredibly volatile and get crushed in a downturn. Gold plays the exact opposite role. It's not designed for explosive growth. It's designed to protect your wealth when other things are falling apart.
So what does all this mean in the real world? How does gold actually fit into a modern investment portfolio?
And this really leads us to the most practical question of all. If you buy into this idea that gold is a crucial diversifier, how much should you actually own?
The expert analysis we're looking at suggests a strategic allocation of about 10 to 15%. Now, this isn't about trying to time the market. It's about having a permanent balancing force in your portfolio.
And that number isn't just pulled out of thin air. The analysis shows that this range gives you the best balance of risk and return over the long haul. Why? Because gold has this amazing habit of going up when stocks and bonds are going down. It acts like a stabilizer for your entire portfolio.
But to really get a grasp on gold's importance, we have to zoom out from our own portfolios for a second and look at its role on the world stage across all of history.
And this isn't just a theory for individual investors. We're talking about the most powerful financial institutions on the planet, central banks. And right now, they're actively buying more and more gold, treating it as a core part of their reserves.
This reveals a major shift in thinking. For decades, U.S. government bonds were seen as the world's safest asset. But even central banks are realizing that holding a promise to get paid in a currency that can be devalued isn't the same as holding the final payment itself. And gold is the final payment.
Just let this number sink in for a second. 80%. That is how many government-issued currencies have gone to zero since 1750. And the remaining 20%? They've all lost a huge amount of their value. And through all of that, gold has remained.
Which leaves us with this one final crucial question. In a world that is just piling on more and more debt, what is true money? The argument we've explored today suggests the answer isn't new at all. In fact, it's been with us for millennia. Definitely something to think about.